Welcome back to Money Pop. Silver is unique. Unlike gold, it carries a major industrial role, while gold only has a minor industrial use. And what makes silver so interesting right now is that its industrial demand is not really tied to economic activity in the traditional sense. It is mandated by governments. Policies pushing the world away from fossil fuels have driven demand into areas like photovoltaic production for solar panels, electric vehicles, and a wide range of electronics. On top of that, we are watching defense expenditure rise across the globe. None of these categories simply vanish when the economy slows down. In fact, they are among the last forms of demand to fade, which is precisely why industrial demand for silver has produced a supply deficiency stretching back 6 straight years. Now, the story is shifting in a much bigger way. China has changed her attitude towards suppressing the silver price in the West. Interest in silver as a monetary metal is growing again, and that movement is only just beginning. What this is creating is essentially a crunch. The shortage of supply that has been building for 6 years is suddenly becoming acute, and the gap will not be filled by China. Chinese silver imports in the first 3 or 4 months of this year have hit record levels. There has been some exporting, but nothing like what we have seen in the past. China appears to be reviewing her export policies quite significantly in the wake of the Iran conflict and the Gulf conflict. We have already seen similar moves with fertilizers and other key commodities. People who follow Chinese trade policy closely are saying that Beijing is tightening up on all commodity exports. We saw this with rare earths back in late September last year. That move was not really telegraphed, but something similar appears to be happening with silver. Within about 2 weeks, there was a liquidity crisis in the London bullion market, and silver lease rates spiked to roughly 40% on top of that. America turned around in the second half of last year and decided that silver was a critical mineral, one that needed to be aggressively accumulated. Was China going to supply this metal to America? No way. So you can see a number of factors conspiring at the same time, all leading toward a very acute shortage of silver. We have already seen a great deal of silver leaving the COMEX, and it has been drifting out of London for some considerable time. Another squeeze appears to be on the way, one that could make those 40% lease rates look small by comparison. What you're hearing here is that silver is no longer just a precious metal story. It is becoming a full-blown global supply crisis. Industrial demand from solar, electric vehicles, defense systems, and electronics has already created 6 straight years of supply deficits. The situation is intensifying because China appears to be tightening exports right as the United States labels silver a critical mineral and begins aggressively accumulating it. That combination is already stressing the physical market, with silver flowing out of COMEX in London, while lease rates recently exploded toward 40%, signaling a major liquidity squeeze behind the scenes. If that trend accelerates, what comes next may not just be higher silver prices, but a genuine physical shortage that changes how the entire market functions. The suspension of the recent operation in the Middle East caused the oil price to fall quite heavily, and somewhat against expectations, gold and silver rallied very strongly. This is probably just a pause. Negotiations are unlikely to change the underlying situation, and America is now in a very difficult position. She has to find a way of retreating from her attacks against Iran without appearing to do so. In other words, some kind of face-saving deal. But the Iranians are not offering one, and if America does back off, that leaves Israel exposed, which is also very difficult. Putting all this together, there is a strong likelihood of a renewed military campaign against Iran. We have no idea about timing, but one military constraint is that within the next 2 weeks, it will start getting extremely hot in the Gulf. American soldiers are not acclimatized to those conditions, which would put them at a huge disadvantage. If America does attack Iran again, the response that Iran has already promised will be extremely severe. They have hypersonic missiles, and while they have not used many so far, they have a lot of them. They have promised that they will basically wipe out infrastructure within the Gulf. We are talking about water desalination plants, which would make countries like Kuwait uninhabitable. We are also talking about the destruction of oil terminals and refineries, which would put a permanent problem on the global oil supply situation, as well as the supply of oil byproducts such as fertilizers and helium. This is extremely serious. The situation is likely to escalate again. China is already making moves to protect herself. She is now restricting exports of commodities she needs, including things like fertilizers, because Beijing knows what is coming. As well as that, she is tightening restrictions on shipping. American ships can no longer visit Chinese ports, and that includes ports outside China that China owns or controls, for example, in Piraeus in Greece, Mombasa in Kenya, and Djibouti at the Horn of Africa. The excuse for this was that America took control of the entry and exit ports of the Panama Canal, which were owned by a Hong Kong-based company within China's sphere of influence. America simply took them. So this whole thing is escalating, and not just as a Middle Eastern problem, but as a global one. How rapidly it accelerates remains to be seen, but it is not good news. The consequences in terms of prices for much-needed products, including specialized industrial inputs and energy itself, will likely produce either a slump in America and Europe, or a very bad dose of inflation. In all likelihood, we get both. That will drive up bond yields, and as bond yields rise, stock markets will come under heavy pressure. The consequences for gold and silver are slightly murky because of how the West responds to these shocks. Recently, when the oil price has risen, gold has fallen. When bond yields have risen, gold has fallen. This reflects the Western response. United States portfolio managers and European portfolio managers, when they see a crisis, view the risk-free position as moving into cash, whether that is dollar cash, sterling cash, or some other major currency. However, throughout the Far East and across Asia, people take a different view. When they see a crisis, they want to get out of currency and into gold where there's no counterparty risk. It is this difference in behavior that has been driving a steady drain of physical metal out of Western capital markets and into Asia. That, in a nutshell, is really where we are. On a macro level, the real thing to watch is bond yields. They are on the verge of breaking out on the upside, which means that bond prices will fall very substantially. Some people are beginning to warn about this. The consequences will be that debt traps on major governments are slammed shut. America, Germany, the United Kingdom, France, and Japan will only be able to fund the expansion of credit through short-term borrowings, basically treasury bills and their equivalents. The idea of marketing long bonds at anything like current levels, you can forget. Worse than that, the problem with a debt trap is that the higher bond yields go, the worse the